use cases of Web3 through DePIN.
Mark, welcome back. It's been really cool to talk to you. We met all around the world in the past conferences all the time, and it's been super interesting to see Aethir's growth. Can you talk about where is Aethir now in terms of numbers, revenue, growth, etc.? And then let's just jump into the next phase, which is the DATs, the Digital Asset Treasuries, and how that plays for Aethir.
Yeah, for sure. Well, thanks for having me. Awesome to kind of be here, particularly on my kind of home soil in Singapore. Always nice to kind of be able to meet up for these things face to face. So Aethir by the numbers at the moment, I think we're reaching a really interesting stage, right? We've been growing rapidly, seeing over 20% growth kind of quarter on quarter from a revenue perspective. We're sitting at around 166 mil in annual recurring revenue now, but we actually expect that to double by the end of the year, so over the next couple of months. So 300 plus mil in ARR by end of December. So pretty exciting moment for us. That corresponds to a big increase in GPUs within our network, right? We've got approaching, I think, 500,000 GPU containers across 93 different countries, 200 plus different data centers, and obviously a whole bunch of fantastic enterprise clients kind of coming to Aethir for training resources, deployment of inference and agents and applications, and then also, our original business, which was providing that GPU compute to gaming companies. It's a rocket ship, I think, at the moment, or it certainly feels like that. But I guess anyone building in the AI space at the moment is experiencing similar sort of things.
Yeah, I mean, you saw, a few weeks ago in Token 2049 in Singapore, where we are right now, and then before in Korea as well. There's so much things happening in AI, and combined with Web3 as well, there's so many companies going to this field. It's quite exciting, and then you guys are providing the backbones of a lot of those things. And you guys basically, on the gold rush, you're providing the shovels. I think that's a good way to put what Aethir is trying to do. Because we spoke, I think, on episode 17 of 2 years ago, maybe? It was before the node sale, and it's been super cool to see the growth. One thing that I always trying to follow up with the project, and it's been really nice to see Aethir's growth. And then I saw the announcement for the DATs, right? I think that's kind of like the next phase of what you guys are doing in terms of like fundraise or like excitement. Can you explain what a DAT is? It stands for Digital Asset Treasury, right? I think there's a lot of confusion out there. I'm still trying to wrap my head around it, and how exciting that is, and how good that's going to be for the ATH token as well, and for the community in general, and for the DePIN ecosystem. It's like so many cool things, right?
Yeah, we're gonna have to kind of break that up, because there's a huge amount to talk about in the broader DAT space, but also specific to Aethir and what we're doing with our DAT. I think first, let's start with maybe explaining to people what a digital asset treasury company is. Something we've been looking forward to in crypto for a very long time is this inflow of TradFi capital, right? This idea that traditional markets start to value the assets that we have within crypto as much as we do, right? There have been a lot of gains in that specific sector this year, right? With ETFs, crypto-based ETFs coming online, a lot of institutional interest in the major tokens, right? Like Bitcoin, Ethereum, Solana. That's very much about traditional markets creating different ways that they can interact with the crypto world. There's not necessarily just this, bridge that they can kind of tap into and instantly access these assets. They have to be pretty thoughtful within the regulated landscape of traditional markets in how they bridge that capital into the crypto world, and then how they manage those assets when they take them out. Now, one of the maybe slightly newer or more innovative ways that we can connect the TradFi world with the crypto world is through what's called a digital asset treasury company. Now, most people in the crypto space may be familiar with Michael Saylor and MicroStrategies, right? Which was essentially one of the very first listed companies that chose to be a digital asset treasury for Bitcoin, right? Effectively, they said, hey, we've got this NASDAQ listed entity. Let's make the job of that NASDAQ entity to acquire Bitcoin, right? Now, the underlying premise is effectively that Michael Saylor can raise money in the traditional market world and he can spend it in the crypto world, and that he can buy Bitcoin cheaper than you can, right? So let's say he goes and he raises $1 billion, right? He can take that billion and he can maybe approach big Bitcoin mining companies, and he can say, hey, I've got $1 billion. I want to buy all of your Bitcoin off you for the next 6 months, but I'm going to buy it at $95,000 per Bitcoin when the market rate, might be 106, because he's got $1 billion, right? Because he's got that kind of capital market leverage, the fact that he's able to use the capital raising efficiencies of traditional markets, he can kind of have that leverage and come in and do kind of interesting and exciting deals, right? So then effectively, he's able to take that billion and buy Bitcoin at a cheaper price than you or I could. So then the capital markets can go and they say, oh, well, if I have $1 and I want to spend that on Bitcoin, if I try and spend that $1 on Bitcoin directly, I'll get $1 of Bitcoin back. But if I go to Michael Saylor and MicroStrategies, I can spend $1 buying a share that represents a piece of Bitcoin, but that $1 might now be worth $1.2 a Bitcoin, because he was able to acquire that Bitcoin cheaper than the market rate. But once it's held by the company, it's priced at the market rate. So all of a sudden, there's this almost a form of arbitrage, right? Where not only do you now have a NASDAQ listed vehicle, which is very easy for Web2 investors to invest into, right? They don't have to worry about custody. They don't have to worry about wallets or exchanges or any of that crypto complexity. First of all, it's just very easy for them to invest. And then second of all, there's this bonus, right? Where $1 into that company is the equivalent of maybe 1.2 Bitcoin, $1.2 of Bitcoin. And that's a pretty exciting model, right? It's largely based around the idea that it's easier to raise large amounts of money within capital markets, and that has an outsized impact on the assets within the crypto world, just simply as a result of the fact that the market cap of our entire sector is not huge when compared to what we see in capital markets.
I think it's a very interesting way that you kind of like gathering money or resources from a lot of people, right? And then you can go and buy anything you want for a discount, like OTC deals, etc. So that everybody wins in a way. And up to recently, that was not allowed, right? Or that's very complicated. I think the new Trump administration probably make this whole thing a little bit easier to digest. Because like Michael Saylor has been doing this for quite some time, but now there are people trying to do with other different assets as well, different tokens. That's what you guys are trying to do, or actually are doing. When did this idea came from, and can you explain now you have what is called the strategic compute reserve, right? Can you explain it from Aethir's perspective? What is the play on the DATs on your end?
First of all, the idea of DAT, I think based on the Michael Saylor explanation I gave before, it's generally bullish for the token, right? You can kind of imagine you've got this huge amount of money on the capital market side that now has a gateway to purchase the token that you hold, right? They come in with their big dollar amounts, they buy that token, and then they essentially sequester it in the DAT, right? It doesn't kind of go anywhere. This is a one-way journey for Bitcoin. Bitcoin now sits in that treasury forever, right? So you've got all of this buy pressure coming in. Buy pressure we know is generally good for token price. And you're getting a reduction in circulating supply as that token is now being taken out of circulation and held in this DAT, right? So this is really interesting. We know with Bitcoin, for example, that rule of thumb, roughly every $1 billion of inflows to Bitcoin results in roughly a 1% shift in price, right? However, that's largely as a result of the fact that Bitcoin has such a large market cap, right? There's so much circulating supply. Stuff starts to get really interesting when you start to kind of move down the majors and you start to kind of get into mid-cap tokens, right? Altcoins. Aethir, for example, has a roughly $650 million market cap, right? When you exclude tokens locked in staking contracts, when you exclude tokens held by foundation, when you exclude tokens staked against compute, right? You actually have only roughly 50% of that circulating supply remaining. So all of a sudden, if you can take, right, say 50 million, which is, roughly what the cash element that Aethir raised, proportional to a $350 million circulating supply, that's actually far more than if Michael Saylor raised $5 billion to buy Bitcoin, right? The proportional impact of that 50 million is actually magnitudes more significant.
Yeah.
It's actually, I believe, the equivalent of Michael Saylor raising over 300 to 400 billion, right? Which is, almost inconceivable. Long story short, about 6 odd months ago, I think the market started to become aware as a result of lowered regulatory risk, with the new administration, became aware of this opportunity, this idea that, okay, banks had a little bit more appetite to support the development of these sorts of initiatives. Investors were interested in the opportunity, and we started to see early movers, right? But it was primarily limited to the majors, right? Tokens that you may consider more popular with non-crypto people.
Like a blue chip token.
Yeah, like a blue chip, like an Ethereum, maybe even Solana was like starting to get into okay, does the average person know Solana? But what was interesting was, you started to see this whole rollout of like Bitcoin DATs, Ethereum DATs, Solana DATs. But what's the incremental value of yet another Bitcoin DAT, right? Once you've got like 5, what's the incremental value of a 6th or a 7th or an 8th, right? There's not a huge amount.
Also, you probably wouldn't be able to raise as much as the first ones.
Exactly. The opportunity goes down for investors. The amount that you can raise goes down. It's not an infinitely scalable solution in that sense, right? However, with Aethir, we were able to pitch a really interesting kind of differentiation, right? So obviously, first of all, no one's ever done an Aethir DAT before. This is the first one. Second of all, we were effectively the first mid-cap token, right? The first token that we believed had the opportunity to raise proportionately a relatively significant amount in relation to the circulating supply and market cap. And then probably most importantly, we were a utility token, right? We have functionality, right? There's this token within Aethir's ecosystem effectively represents GPU compute, right? The infrastructure that powers AI. And this narrative, coupled with the fact that we have a fundamentally good business with 160-something million in ARR, right? Put us in this really interesting position where in some ways, the traditional markets value us more than the crypto markets do. We know how crypto doesn't necessarily appreciate revenues, right? It's not something that is front of mind for the average crypto pundit. It's much more about kind of speculation. But traditional markets, they love revenue. They price it, right? And this idea that we could take this functioning business with extremely strong revenues and massive growth, quarter on quarter, and package that into a DAT and then raise money on the capital market side and use it to kind of create these really interesting feedback loops with the token was something that we're able to get, some of the biggest banks on Wall Street behind and raise, a significant amount of money and tokens to support it.
You know us from the podcast, but now we've gone vertical on TikTok. Every week, we're dropping short videos on the most trusted DePIN projects, latest news, and what's really worth your attention. So if you want to stay ahead without the noise, follow us on TikTok at DePINHub_official. Back to the episode.
Yeah, one thing that I'd like to tell everyone listening to this or watching, no financial advice on this. but it's a very exciting time, right, to be
Yeah.
in this space, especially because I think, like you mentioned, being like a lower market cap project versus Ethereum, Bitcoin, Solana,
Yep.
and being such a strong fundamentals and strong backends and backed by revenue, I believe. It's such a great opportunity for you guys to be the first one with such a strong utility, right? Because you say like Ethereum has utility or Solana has utility, but that's just like the gas for the blockchain infrastructure. You guys have so much more. And I think AI is such a strong narrative. Like there's so much tailwinds right now on that everybody should be jumping on board with that, I think. And I think one of the reasons why I'm so excited to be talking to you about this, because translating what you guys are building, because it's not a very easy, I think, to understand. Like I said before, I'm still wrapping my head around this. But the more I learn, the more I can see the opportunities. If you are a DGen or Web3 guy, you can just go and buy the token. But I think even that, you can buy the DATs and has some more upside as well. What were the main challenges that you guys have when deciding to go this route as well?
Yeah, I mean, the big challenge that will face any project outside of the kind of the blue chips at the very top is that you'll go to a bank, you'll go to these institutions that essentially need to support your fundraising efforts, right? And they may not know who you are, right? They know who Bitcoin is, they know who Ethereum is, but they don't know who you are, right? So you need to have something really compelling to go to them with, to convince them to put their name alongside yours when you go out and raise your money kind of in this institutionally kind of regulated world. So for us, it was very much about the education side of things. Why are we interesting? Why do we feel that we're incredibly relevant right now? Why do we think that doing a DAT with us is better than just doing another DAT with the next Ethereum opportunity that comes by? And I think we were able to really drive that home. Obviously, having this tailwind of GPU infrastructure and data center deployment and massive compute shortages was something that I think in general is really appealing to anyone that's kind of been paying attention to the stock market over the past kind of 2 years. So we were very lucky. I think if we'd come to them and not had the revenue, however, narrative wouldn't have mattered, right? We needed to be able to show these banks that this wasn't just a speculation play. This wasn't just us saying, hey, we've got some GPUs and we think they'll be useful at some point in time, right? We were able to say, hey, here is the infrastructure. Here is the deal flow, the revenue, the customers, and this package that we have is going to be incredibly interesting to Web 2 financial institutions, right? Because you're not convincing, when you're raising this investment vehicle on the TradFi side, yes, some of your investors will be crypto adjacent, right? Funds that participate in both the crypto world and the TradFi world, but much of the capital is going to come from Web 2 funds, and they really don't care too much about your token, right? They're much more interested in the fundamentals of your business.
Is the tokens are going to be locked on the DAT as well? Is it going to be staked? Like it's going to grow in terms of like value for the people who actually buy the stocks?
Yeah, so that's a great question, right? Because the big question with DATs in general is, what do they do with the Bitcoin? What do they do with the Ethereum, right? And to be fair, if you have kind of a protocol token, or if you have like Bitcoin, there's not much you can do with it, right? And yields on Bitcoin, for example, are incredibly low, right? So whether you stake it or not, there's really not much that you can do. All you really can say to your investors is, I'm not going to sell it, right? It'll still be here. And the price of Bitcoin has accumulated at this rate over the last 10 years. We expect it to continue in this direction. Here's why. And buying $1 of this stock today that represents $1.2 worth of Bitcoin is a good investment. Now, with Aethir, things are very different, right? Because the Aethir token has fundamental utility, right? It can be put to work in really, really interesting ways. So we actually have a couple of different ways that the DAT will use the Aethir token to not just generate yield, but also to generate revenue for the business, right? So the most obvious and what you just mentioned, the simplest structure is you take that ATH and you put it into any one of the protocol managed like staking pools, right? Generates a yield, 15, 25%, whatever it is, right? But I don't think that's very interesting, right? If that's kind of all you could do with the Aethir token, I don't think, again, that the DAT would have gotten as much attention as it did. What the DAT will most likely do, and again, Aethir is not in control of the DAT. It's a separate third-party entity that stood up and said, hey, we want to be the ones that run the DAT. But what we expect the operator of the DAT to be doing is kind of a combination of two things, right? First of all, they have a whole bunch of tokens. Actually, I'll take a step back. One of the big challenges that Aethir is addressing that I think is really, really interesting to kind of think about is the fact that we're a DePIN, but no DePIN before Aethir has ever had to onboard infrastructure of the scale that we're currently onboarding, right? We're talking GPU clusters, $50 to $100 million worth of infrastructure at a time, right? Now, as you know probably better than anyone, traditionally within the DePIN model, you have to manage counterparty risk, right? If someone else is contributing hardware and then you're selling that hardware to a customer, right? That's not your hardware. So if they misbehave, right, how do you mitigate that risk and make sure your customer is looked after? Well, the best way to do that is to get the hardware provider to put a deposit down. So just like when you stay at a hotel, you'll have to pay a deposit. If you behave, you get the deposit when you leave the hotel. A hardware provider in a DePIN network generally has to do that as well, right? So that they adhere to the contractual terms that they make, that the network or protocol makes with the customer. Now, just like at a hotel, if you stay at the cheapest room, your deposit will be small. But if you're staying in a penthouse, right, and $100 million cluster is the penthouse of data centers, right? If you're staying in the penthouse, you will pay a proportionately higher deposit, right? So for example, if you have $100 million worth of GPUs, you might be required to pay a $3 or $5 million deposit. Now, no one has $3 or $5 million just sitting in their back pocket, right? Why would they not just buy more GPUs, right? The business is GPUs. So we've reached this point at a network where we've got on one side these massive GPU clusters that are coming to us and saying, hey, we see the economics of your model, we see the utilization within your network, we'd love to, deposit our GPUs into your ecosystem, but we don't have $5 million sitting on the sidelines, right? And then on the other side, you've got these massive AI companies which are coming to us and saying, hey, we want $100 million compute contracts. And we're saying, okay, we've got the demand side sorted, we've got the supply side sorted, but we need to kind of solve this staking gap, right? Now, we've been working very hard on a couple of different solutions, one of which is obviously the EigenLayer partnership, which I'll talk about maybe at another time. But the DAT is also one of those solutions, right? The DAT accumulates all of these tokens. Well, if we've got a big compute cluster, and then say an AI customer that wants in, what the DAT can do is say, hey, big compute cluster, I'm going to loan you that stake, right? But I want a portion of your revenues until you pay me back plus 50% or whatever the deal is that the DAT structures. So the DAT actually operates as a deal flow enabler at serious scale, right? That is obviously one of the reasons why we think we'll hit over 300 mil by the end of the year. It's also one of the reasons why we think we're on track for over $1 billion in revenue by the end of next year. So it's incredibly exciting, but that is one way that the DAT is able to generate yield or revenue from the tokens they hold. But the real killer, right? The absolute, in my opinion, piece of genius in how this DAT is structured that really moves the needle is actually when the DAT takes ownership of the compute itself, right? So here's what happens. The DAT accumulates tokens, right? We raised 344 million. It's got 344 million of tokens sitting in its treasury, right? So it goes out and it takes some of that cash, right? And it needs to accumulate tokens. Well, first of all, unlike other DATs, we forced a condition on the Aethir DAT that it has to spend its money buying the token on market. It can't do OTC deals. It can't do kind of a backroom deal with the foundation or anything like that. It has to buy the tokens in the same way that you or I would buy on an exchange or a DEX, right? But if it does that, the foundation will give it a 20% bonus, right? So if it spends $100, it'll get an additional $20 of ATH, right? So how this works is, let's say it's got $100 million worth of cash. It goes out and it buys $100 million worth of ATH on market, right? Which is a good thing. Buy pressure is a good thing. It then receives an additional 20% bonus from the foundation. It now has $120 million worth of ATH. So what does it do with that? It books $120 million worth of GPUs within Aethir's network, and it rents that to an AI company. Now let's assume it rents it for no margin, right? $120 million worth of compute, rented out for exactly $120 million worth of cash. All of a sudden, at the end of that contract, the DAT now has $120 million in cash. What does it do with that 120 mil? It goes and buys ATH on market again, right? So it now has $120 million worth of ATH plus another 20% bonus from the foundation, right? So it's got $144 million worth of ATH. It now rents $144 million worth of ATH GPUs. Rents that out to an AI company. Again, assuming no margin, it gets 144 mil, right? So this cycle, right, is incredibly bullish, right? Yeah. For a couple of reasons, right? First of all, this DAT is booking real revenue, right? And we know that revenue is something that traditional markets price really well, right? So CoreWeave, for example, which is a very similar business model. It's a neo cloud, a GPU cloud in the capital market space. It's priced at roughly 20x its revenue. That's a pretty insane number, yeah. Right? And none of the DATs are priced in that sort of manner because they don't generate any revenue, right? On top of that, every time it generates revenue, it's using that revenue to buy back the Aethir token, right? So it's permanently reducing kind of circulating supply, putting a huge amount of buy pressure on the token, which is again a great thing for the ecosystem. But using that model, the DAT is able to function as an incredibly successful business, almost on its own right, and Aethir becomes the fuel powering this machine, right? That is in many ways kind of like a traditional market sibling to the main company. And then you have this really interesting environment where you've got access to all of the capital raising opportunities within the traditional market space, but any capital you do raise, you spend in the crypto world. And that is just a very, very cool thing.
This is extremely bullish. And I think if it was a market that's kind of stagnating in terms of like demand, that probably wouldn't work.
Sure.
But we are talking about AI, and I think we're just getting started on the demand. Mm-hmm. I can see like so many, all the big companies around the world building data centers left and right. There's so much money, so much resource that I think we're just in the beginning of something quite big. And I think the way that you structure this whole flow, you're going to keep growing, because I think we won't ever have enough like supply of AI compute required for everything that we're building right now. Super, super exciting. And I think also what you explained helped a lot with the doubts. Like from what you've seen, what was the biggest questions and misunderstanding of the community in terms of this whole debt?
Yeah, I think in general, one of the biggest confusions around DATs are around how in-kind investment is, how that works, or why it's important, right? So let's say you're raising for a DAT and you've got investors, right, that want to come in, right? On one side, you've got investors that want to invest cash, and on the other side, you might have investors that want to invest the token, right? Now, the DAT wants as much tokens as possible, right? So if, for example, a investor who maybe has a whole bunch of tokens wants to contribute those tokens, but they're not vested yet, right? They're still kind of unvested. That's actually a good thing, and I'll tell you why. So first of all, similar to an OTC deal, for example, if someone tries to buy locked tokens, they buy them at a discount, because who knows what the market will look like a year from now or whenever it is that those tokens vest. There's uncertainty there, and as a result of that, the price is discounted, right? So you might discount those tokens when they're coming into the DAT, right? So the DAT now gets to acquire a larger number of tokens, right, for a cheaper amount. And then it can obviously stake those tokens or do whatever it needs to do, or in Aethir's case, it can go out and rent compute using those tokens. Now, that in itself is a good thing, right? More tokens in the DAT means the DAT's more functional, it can do more things, it can operate at a higher scale, right? It's overall bullish for the ecosystem. But the real value there comes when you consider what that investor would be doing once the tokens vest, right? They're going to dump, right? Every VC or institutional investor has a mandate to provide ROI for their LPs, right? They need to book a profit. VCs, in general, are not long-term hodlers because they have to make money for their investors. They've got to sell their asset, right? Now, if you have a VC on your cap table that has a whole bunch of unvested tokens, it would be far better for you as a token holder if that investor was put into the DAT and given shares instead, because now all of that sell pressure that would be happening from that investor vesting via the token is now happening in the DAT through the shares, right? So that investor no longer has any tokens anymore, they only have shares. All of their tokens were converted to shares, and they can only sell shares. So you've effectively permanently removed sell pressure from your token. So if you can imagine, right, let's say you were 100% effective at moving all of your investors in the DAT. You've now removed effectively all VC sell pressure from your token. That's like the dream.
It's unheard of, basically.
It's crazy.
Yes.
It's literally impossible. Even with OTC, right, all you're doing is effectively exchanging one person who will sell the token for another, right? This is a permanent removal of sell pressure from your token, and that is insane. It's not possible really in any other mechanism. So sometimes I feel like I've heard, it kind of parroted on crypto Twitter that, in some ways when a project announces that they've done a really big raise, but a significant portion of that raise is in-kind investment, for example, it feels like, maybe there's, maybe I shouldn't feel as good about that number because it's not cash, right? No. Remember that all of the tokens that are contributing to that value that are being put in the DAT, that's permanent sell pressure. It might not be immediate buy pressure on the token, but it's incredibly long-term bullish for the token itself. In my opinion, if I was to kind of classify DATs in order of kind of the perfect structure, right, I would say a DAT that was purely token, right? So just like they raised money just through token contributions. That's kind of the the least good, right? But still good for the token, still like bullish for the token because you're removing circulating supply, removing sell pressure, still bullish, but not perfect. Second is pure cash, right? Good, but oftentimes you can get more bang for your buck initially during the fundraise if you're pulling in discounted tokens, right? So maybe you have $100 million of cash, but maybe it would be worth a little bit more if you did 70 million cash and you tried to get like the rest in kind, right? So long story short, my ideal DAT structure is a strong cash raise, but alongside a strong token raise. Those two in combination give you that really powerful buy pressure, but also this reduction in circulating supply at and sell pressure with a little bit of leverage, right? Because generally the token contributors are willing to accept a discount because they're unlocking into shares that are not required to vest.
And so TLDR, extremely bullish. We're getting to the time that we need to wrap up here. What is something that you like to tell everybody who is listening or watching this, and how excited this is, right?
We're coming off a couple of pretty dramatic events in crypto over the last week, right? Biggest cascade of liquidations in crypto history. 19 billion wiped off the market in minutes. And I read a post from Cobby that I ended up retweeting, and it was effectively in moments like this, if you hold assets that you have conviction in, right, you never really lose anything, right? The opportunity, the situation becomes an opportunity, right? And if you have stables to deploy, good for you. If you don't, no big deal. You're only really screwed, obviously, if you use leverage, but let's forget about leverage for a moment. You're only really screwed if you hold low conviction coins, right? Something that you thought was just, I've been told it's going to go up, right? So in these moments, and particularly on reflection of the way the market's moved over the last week, fundamentals are becoming really important for a token, right? If everything goes down, what's going to come back? What can you kind of guarantee that's going to come back? And I think one of the things you'd put on that list is tokens that have revenue, right? Because they can function and survive, and they will start to buy back their token. So for me, I look at what we've built with the DAT. I look at the revenues and the growth that we're seeing in this business and the narrative that's kind of broadly underpinning it all. And I think there's very few long-term plays as powerful as the one that Aethir is making. So, like I view any price action like the last kind of week as a massive opportunity to kind of come in at a discount and get some pretty incredible exposure to, I think, a very, very exciting asset class.
And also a long-term play as well. Well, thanks so much, everyone, for listening. Thanks, Mark, for
having me.
It's really nice to talk to you all over the world. It's extremely exciting about what you guys are building and bright future ahead.
That's it, man.
Let's
it's
build.
Exciting.
Cheers. Thanks, man.
Thank you.